Hey, Saretsky here. Welcome back to the show. I am just in Toronto. We just finished up our Loonie Hour live event. So filming this video before I fly back to Vancouver to get our regular Saturday show. As always, super humbled by the people that came out to the Loonie Hour show. A lot of the people that I was able to meet said they've been watching this show. They've been watching the show for 7 straight years and then discover the Loonie Hour through that, and then obviously getting the chance to meet them. So, super appreciative for that. But I kind of want to summarize a lot of what we talked about at the event. The questions that we had following the event when people come up and shake our hands and ask me, what I think about housing, and a lot of times they're the same questions. And so I kind of want to walk you guys through that. But, really just looking at, bank earnings, right? I mean, bank earnings were out this week here in Canada. The overwhelming sort of takeaway is you can see the provisioning for credit losses. So that's basically how do they feel about the outlook of the economy? And so, there was an example during the depths of the pandemic where RBC, for example, actually had like negative loan loss provisions. So like negative. And now, we're seeing them double on a year-over-year basis. And so, pretty much all banks basically more or less doubling their credit loan loss provisions. So it's really just telling you the banks are setting aside more money for loans that are going to go bad. And I think that makes sense. I mean, if you think about it, again, less than 50% of Canadians by the end of this calendar year will have seen any mortgage payment increase. And so there's still a lot of people that are coming up for mortgage renewals and things of that nature that are going to be, struggle with their loans. And if you think about it, in the real world is when your mortgage payment goes up by, let's say $1,000 a month, you don't immediately just foreclose or stop paying it. I mean, you start cutting expenses wherever you can. And you slowly, you try to make it work. And I think, there's a lot of people that can hang on for, 12 months, 18 months, 24 months. And eventually it just sort of compounds and you can't quite keep up. And so I think that's, again, you will see the number of foreclosures start to increase into next year. And so that's just kind of the reality of it is, you think about even that someone that's on like a private loan, right? Like they're not getting a tier 1 loan. Like you've got a private loan, a lot of people on private loans, again, will get through, 8% interest only loans for 12 months, 18 months. And eventually when you can't refinance into say a traditional loan, that's when you eventually basically default, and that process takes time. And so I still think that's happening. So, seeing the banks, basically what they're sort of forecasting is, okay, we're going to start cutting jobs and we are going to basically brace ourselves for more loan loss provisions. And so we look at, we pulled the GDP numbers in Canada came out Q3, negative 1.1%. The Bank of Canada's forecast was for 0.8% growth. So a huge divergence there. Of course, you got a revision in Q2. So we're not in a technical recession. But for all intents and purposes, we asked everybody in the room last night to, raise their hand. We said, everyone here is working or owns a business or, in various different fields. And we just said, listen, is the economy, in your opinion, is business better or worse? Or has it flatlined? And the overwhelming consensus, everyone raising their hand in the room, was things are worse, or at best they're flatlining. Like almost nobody in the room said, well, things are actually better for me. So, and again, keep in mind this is in the GTA. It's a relatively small sample size, but I think it kind of encompasses, I think, what most people are feeling, which is like the economy is getting worse. It's things are tougher. If you look at real GDP per capita, which is really what matters the most, it's just are we getting better? Are we getting more prosperous or not? And real GDP on a per capita basis has been declining for 5 straight quarters, which is pretty much more or less in line with the Bank of Canada started raising rates. And so I think that you can see this, you can see it being reflected in polls and whatnot. And so now the question is really, okay, what's next? So we've got the Bank of Canada coming out next Wednesday here. And I think all the data suggests it's going to be another hold. So, no rate hikes, no rate cuts. I think we're past the days of hiking rates. It's really just like, when are we going to see some cuts? And so right now, again, not me, markets are pricing in 50 basis points of rate cuts next year by the Bank of Canada. Again, are we going to get 50? Are we going to get 25? Are we going to get 100? Nobody knows. Nobody knows. And so, basically at the end of the event, people are saying, oh, what should I do about housing? Like, when should I buy? How do I time this thing? And like, I think for most people is they're going to twist themselves into a pretzel trying to figure out the exact perfect moment in time to buy real estate. And I think the biggest thing I should emphasize here is like, buy real estate when it makes sense for you. If you can go out there today and negotiate a good deal, you can buy a great property, a nice piece of land in a good location. I think you're going to be just fine over a 5 to 10 year holding period. Like, it's going to be a rounding error in the grand scheme. Now, again, if you're competing in multiple offers and you're buying a condo that you're planning to flip in 2 years, like, good luck. Like, it's like a mugs game. And so it's like, buy real estate well and buy it in good locations. So like, I look at it like, so for example, like, again, and that's always like product type, where are you buying, what are you buying for, what's your time horizon, right? Like, I think like the idea of like time horizons of real estate, like less than like 8 to 10 years is stupid to begin with. But like, for example, like if you're a landholder in like Vancouver, greater Vancouver or greater Toronto area, the reality is we're going to continue to densify. And so it's like, the winners are really the landholders in those two cities. And so again, I'm just saying, you can go 5, 6, 7 years with no growth. But at the end of the day, it's like, well, if you've utilized that property and you're living it as a primary residence, like, are you really going to be upset with yourself? Like, no. But the landholders in those areas, and again, I can't say the same thing for condos. I'm not a big condo person. I get, people need to live in them, and they're relatively more affordable. I get it. But if you're just talking about like longer term, 10, 15 year time horizons, people that own land are going to do well. We just saw the BC government a couple of weeks ago passing multiplex on all single family lots in BC. They then densified transit locations. So again, if you're within 800 meters of a SkyTrain station or bus exchange, they're mandating higher density. And so this is BC. I can almost guarantee you Ontario is going to follow suit, because they've been following all of BC's policies, including the foreign buyers tax and empty homes tax, for many, many years. And so that's coming. And so basically what's going to happen is, again, you're getting a free land lift from government regulations. That's just what it is. I mean, governments are still looking at it and saying, politically, housing is still a problem. Politically, housing is a problem. We have horrible affordability. I don't think that's going to get materially better in the next 3, 4, 5, 7, 8, 9 years from now. And so governments are saying, we got to do something. We now need to make more drastic, draconian measures. And we're going to remove zoning, for example, from municipal governments, and we're going to force feed higher density. So again, I look at it and say, well, again, if you're like a landowner, I mean, and with a 10, 15 year time horizon, the reality is like single family housing in cores of major metropolitan cities, I still think you're going to do well. Now, don't get me wrong, you're going to have volatility in prices over the next 12 to 18 to 24 months. Like, that's just the nature. When rates go from 0 to 500 basis points, you're going to have problems. And we can still see that. I've obviously been the first to talk about it, on social media here about, developments and developers that are facing the gun. A lot of them are going to end into receivership, and there is going to be this downturn, these issues on that space. And we know that housing starts are rolling over, and they're going to continue to roll over, and you'll see some unemployment in that sector. It's funny enough, actually, there's a good report from Altus Group that came out a couple weeks ago showing that employment in the construction sector is actually down. So the construction sector is doing more firing than hiring this year. So when we talk about supply and the lack of labor in the construction industry, we're actually doing more firing than hiring today because these jobs, these projects are no longer economically viable. And so that's just the nature of what is happening in the market. So to kind of summarize, really, it's still tough. You look at interest rates. How much are we going to get cuts? How many cuts are we going to get? The only issue that I find is like by cutting rates and by yields falling, right? We've seen like 50, 60, 70 basis points decline pretty much across the curve over the last 4 weeks, right? So the best month for the bond market is since 2008. But that is an easing of financial conditions. In fact, it was one of the loosest financial conditions, the change in direction over the past month. And so that when you ease financial conditions, it does sort of allow inflation to come back potentially. And so that's something that markets are going to have to figure out over the next 12 months. As rates fall and financial conditions ease, it does potentially stoke the inflationary fires. So we'll see how this all shapes up. I think long story short, again, it's going to be a very volatile 12 months coming up. There'll be winners, there'll be losers. But I think people that are looking in the housing market, if you ever have any questions, you guys can always email me. I try to get back to everyone as much as I can. But those are my thoughts. So as always, see you next week.